Welcome! In this video, is there a 330% chance that Zbcn will increase by 330%? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
In financial markets, one of the most closely watched structures in technical analysis is the descending curve or descending trend line. This type of curve indicates that the price has been moving downward in the medium or long term, and each new peak forms below the previous one. This pattern signals that the market is under selling pressure and that buyers are struggling to push the price higher. However, such structures eventually break because no trend lasts forever. In the current scenario, we are at a critical point. The price has managed to break above the descending curve it has been moving below for a long time. Moreover, following this breakout, a retest process is now underway. First, it is important to understand the descending curve. This curve is drawn on the chart by connecting the highest points the price has reached over a certain period. As time goes on, the price remains below this line and bounces back every time it touches it on an upward move. This creates the perception among investors that whenever the price reaches this level, sellers step in. As a result, this line acts like an invisible but strong wall. However, this wall does not always remain solid. When a strong enough wave of buying occurs, the price breaks above this curve. Such a breakout is often the first sign that the trend may be reversing. That is exactly what is happening now. The price has managed to break above the descending curve that has kept it under pressure for a long time. This breakout shows that the power of sellers in the market is weakening and that buyers are becoming more dominant. However, in technical analysis, breakouts alone are not enough. Sometimes the price may briefly move above the line and then fall back immediately. This is why the retest phase after a breakout is so important. A retest means that the price returns to the important level it has broken and tests it. This serves as a confirmation stage to see whether this level now acts as support instead of resistance. If the price bounces upward after reaching this level, it indicates that the breakout is solid and sustainable. If the price falls back below this level, the likelihood of a failed breakout increases. At present, after breaking the descending curve, the price has returned to this level. From a technical perspective, this is actually a very healthy development. This is because steady, confirmed moves are much more reliable than sudden, uncontrolled surges. The retest process both increases investor confidence and provides a solid base for the price to begin a new upward wave. What matters here is how the price behaves during the retest. The first thing to look at is trading volume. If the volume is low during the retest, it is generally interpreted as a natural correction. If the volume is very high, it may indicate a fierce battle between buyers and sellers, and the direction of the price may become uncertain. The second important factor is candlestick formations. In particular, the formation of green candles with long lower wicks during the retest indicates that buyers are stepping in strongly at this level. The psychological aspect of this process is also extremely important. Closings above the descending curve give morale to investors who had been under selling pressure for a long time. Many begin to think the downtrend is over and start buying. This can trigger a new wave of buying after the breakout. If, during the retest, the price finds support at this level, it reinforces that belief and allows the upward movement to continue. Such breakouts are often precursors to larger price moves. Breaking a descending curve removes one of the most important technical barriers in front of the price. This attracts both short-term speculators and medium to long-term investors, bringing fresh buyers into the market. If macroeconomic conditions and the overall market trend are also favorable, the momentum of the rise can be much stronger. If the retest is successful, the first targets are usually the previous horizontal resistance levels, areas where the price has previously struggled and sellers have stepped in. If the price also surpasses these, the rise can extend over a much wider range. Another important point to consider is the stop-loss strategy. If the price unexpectedly falls during the retest and drops back below the broken curve, it must be remembered that the formation could fail. For investors, this situation carries both opportunity and risk. It is an opportunity because breaking a downtrend and moving upward after a retest often offers significant profit potential. It is a risk because not every breakout is sustainable, and false breakouts or fakeouts are common in the market. This is why the retest phase must be monitored carefully. Many charts that have broken a descending curve and moved upward after a successful retest have seen very strong trend reversals in the past. The reason is that this move represents a trend change, both psychologically and structurally. Psychologically, investors who have been under pressure for a long time return to the market after the breakout. Structurally, the price begins to use a level that previously faced constant selling as support. At this point, investors' entry strategies may differ. Some enter a position at the moment of the breakout, others wait during the retest, while cautious investors open positions only after seeing a clear upward reaction following the retest. Which approach is correct depends entirely on the investor's risk appetite and strategy. In any case, descending curve breakouts and retest phases are considered among the most reliable signals in technical analysis. In conclusion, the current picture shows that we are at a very critical technical juncture. The descending curve has been broken, and now it is time to test the strength of this breakout. If the price emerges stronger from this retest, we may see much higher levels in the coming period. Therefore, closely monitoring both technical indicators and market psychology will ensure that this process is interpreted in a healthy way. But we can't make a decision based on the curve alone. Let's take a look at other metrics as well. Stay tuned.
One of the most important concepts closely followed by professional investors and large funds in the markets is the order block. These represent areas where the price has reacted sharply in the past and where either buyers or sellers have stepped in aggressively. A bearish order block, as the name suggests, is a zone where sellers have previously taken heavy positions and where upward price movement was halted. In technical analysis, these areas are among the toughest barriers for price to overcome because sellers here have previously pushed the price sharply lower and often step in again to drive it down. In the current scenario, the price is moving exactly at the level where such a bearish order block exists. This causes short-term price compression, with repeated attempts to move upward followed by pullbacks. Understanding how order blocks are formed is essential to interpreting this situation correctly. These blocks typically form when the price makes a strong upward move, then suddenly reverses and continues downward for an extended period. The area where this reversal occurs is where sellers have collectively executed trades and released large amounts of orders into the market. A bearish order block is where supply overwhelms demand. This is where sellers are strong, offloading their positions or opening new short positions. For this reason, when the price returns to this zone, it often faces the same reaction again. Sellers re-engage and buyer strength is tested. If the price cannot find enough volume and buyer support within this block, a new downward move begins. What we are currently seeing is the price returning to this bearish order block and struggling there. On charts, this type of structure usually requires multiple attempts to break through. On the first touches, the price often gets rejected and pulls back because the sell orders within the block have not yet been fully absorbed. Over time, as buyers absorb more orders inside the block, sellers' strength is diminished. Once the block is broken, the result is usually a strong and rapid upward move. To understand this process, it's necessary to closely observe price behavior. Before a bearish order block is broken, certain signs often appear. First, each pullback forms a higher low, showing that buyers are gradually strengthening. Second, the price remains inside the block for longer periods during each attempt, signaling weakening seller power. Third, trading volume increases within the block.
When market charts are analyzed, there are times when the price slowly declines over a certain period, then climbs back up at the same pace to return to its starting level, and then moves sideways for a while. These structures are known in technical analysis as a cup formation. The cup formation gets its name from its shape, as the price movement forms a curved structure on the chart resembling a bowl. The basic idea behind this formation is that the market first experiences a gradual decline, then recovers just as gradually to reach its previous level. When such a structure forms, the rules of technical analysis show that the price often tends to surpass this level and rise further by an amount equal to the depth of the formation. In this case, the cup formation in question is small in size, meaning it has not spanned a very wide time frame and its depth is not very large. However, this does not mean the formation is ineffective. On the contrary, small cup formations, especially in highly volatile assets, can lead to strong price movements in a short period. Small cups are usually completed more quickly because investors notice and react to this formation faster. In the current situation, when the cup formation breaks, if the price reaches its target, there is approximately a 330% potential increase from the current level. For short-term investors, this represents a highly attractive opportunity. A 330% rise offers returns that many investment instruments cannot deliver even over many years, and it can happen in a much shorter time. This also shows how powerful a signal the formation can be. Looking at the psychology behind the cup formation, we can see that it reflects investor sentiment on the chart. In the first part of the formation, when the price begins to fall, there is general uncertainty and selling pressure in the market. During this time, some investors exit the market, while others choose to wait. When the price reaches the bottom level, selling pressure decreases and buyers gradually step in. From this point on, the price enters the second half of the formation and begins an upward recovery. As investor confidence returns, buying increases, and the price rises back to its previous level, completing the mouth of the cup. At this stage, when the price reaches the top of the cup, a critical threshold emerges. This is a resistance zone where the price has struggled and reversed in the past. If buyers can break through this zone with strength, the formation is completed and a rapid move toward the target begins. At the moment of the breakout, an increase in volume is usually observed, as many investors have identified the formation and see the breakout as a buying opportunity. Whether the 330% potential rise materializes largely depends on the strength of this breakout and the subsequent buyer support. If the price remains above the top level of the cup for several candles after the breakout, this shows that buyers are strong and increases the likelihood of reaching the target. However, if the breakout is weak, the price may fall back into the cup, invalidating the formation. For this reason, in such formations, investors should consider not only the target, but also the quality of the breakout and overall market conditions. Another important detail to note in cup formations is the time it takes for the formation to develop. Cups that form over a longer period generally produce stronger and more sustainable moves. However, even with smaller cups like the one mentioned here, especially in volatile markets such as crypto, large percentage increases can still occur. The advantage of small cups is that they can reach their target much faster after a breakout. Cup formations can sometimes turn into what is called a cup with handle structure. In this case, before breaking the top of the cup, the price moves sideways for a short period or experiences a slight pullback. This represents the market taking a final breather and the absorption of the last supply from sellers. The breakout that follows is then usually stronger. If the current formation develops such a handle structure, the breakout may be more solid. It is also worth explaining the meaning of the 330% potential rise in more detail. Such an increase offers the possibility of multiplying an investor's capital several times. For example, an investment of $1,000 would become $4,300
if this target is reached. Of course, this is not a guaranteed scenario, but technical analysis shows that such an outcome is possible. This is why investors often seek to take advantage of opportunities in reliable patterns like the cup formation. In conclusion, this small cup formation contains significant potential within the market. By projecting the depth technically to the target, we arrive at a 330% potential rise from the current level. However, the key factors are whether the breakout occurs, how strong the move upward will be after the breakout, and the level of buyer interest in the overall market. When these conditions are met, achieving the target of the cup formation appears quite possible from a technical perspective.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.